right, the highly anticipated May jobs report, that's going to be released tomorrow morning at 8:30 a.m. And the report is expected to show weaker job growth in the United States. Exactly how tepid are those numbers going to be, and what does it mean for the economic recovery? My guests are Chuck Lieberman, Chief Investment Officer, Advisors Capital Management. He is also the former economist with the Federal Reserve Bank of New York. Also with us, we have Rick Bensignor. He is the Chief Market Strategist at Dahlman Rose. Gentlemen, good to have you with us. Rick, Chuck, let me first turn to you. The economic data that we've been trying to assimilate, whether it's the Institute for Supply Management, whether it's the ADP payroll report, durable goods orders, home sales, real estate values, it's enough to make someone want to crawl under a rock at this point. Not that great.
That's right. We've clearly hit a soft patch. I think some of that, in fact, a lot of it, is related to a couple of variables that we do know about. One, of course, is what happened in Japan and the fallout from that. Literally, there was a disruption of the supply chain around the world. And some of the more vulnerable sectors, like the car sector, really got hurt. And that has a significant impact on industrial production, payroll employment, orders, durable goods orders, and so on.
And that means people that maybe don't have money to go out and buy a house.
Well, I think that's a little bit, that sector has its own unique characteristics.
Well, I'm glad you take issue with me a little bit there, because I wanted to draw you out on this idea of a housing recovery. When's it going to happen?
I do think we need more job growth, but I do think that's coming. And so I think by the end of the year, we should see a stronger housing market. All
right, Rick Bensignor, we listened to Chuck Lieberman. He gives us the why. You just look at the charts and you tell us what people are doing. What are people doing? And based on your experience, what is likely to happen, let's say, in the near term?
Okay. We think a lot has to do with actually the jobs numbers tomorrow, the market's reaction. Today's low in the S&P tucked underneath 1312, but we closed above it. Last week, 4 different days, we traded down to 1312 and held above. So it's clearly a critical level to us short term. And anywhere from there down to 1296, as far as we're concerned, is really what's going to hold this bull market up. Breaking through there, we think, opens the door, much more so than most PMs would probably anticipate, for
portfolio managers, for those in the know. All right, yeah.
For a move that could break under this year's current lows, which is 1249. So we think we either hold right here or we break to new lows.
No chance of moving higher. What would it take to move higher?
No, I'm not saying that. If we hold right here.
If we hold right here, then we do move higher?
Yeah. Yeah, and if we get through,
you're starting to sound like an economist on the one hand and on the other hand, right?
Sometimes you have to let the market tell you which way to play. The bigger picture, medium term, nothing's changed yet. But we do think the medium-term picture does change. And at least, let's say, the short to medium-term picture will change.
What are we talking about, 3 months?
Yeah, the summer. We could have a nasty summer.
Nasty summer. Chuck Lieberman, what do you think?
I think he sounds like a technician. If we don't go down, we'll go up.
There you go. You see? You get the picture. You get the picture direction. So what do you think? A soft summer?
Well, until the data start to improve. I think some of the factors that drove the economic data to the downside are clearly temporary. As the Japanese rev up production again, that'll come back very quickly. That'll filter into the U.S. Some of the other factors, the huge increase in oil prices that drove up gasoline costs and obviously took away some disposable income from households, that has reversed, at least in part. That'll put money back in consumer pockets. If we start getting some of those things turned around and start seeing better economic data, then I think we'll be up to the upside again.
So you're buying in anticipation of this potential upturn?
We find values pretty cheap. We think that stock values at current levels are very attractive. Even if growth stays sluggish for a while, corporate profits are going to continue to rise. So price earnings multiples continue to compress. So we find current valuations very attractive. We think there's limited downside. And so we're very comfortable buying at these levels.
So what kind of companies, what kind of industry groups?
Well, again, we want to be sensitive to where the economy is going. We want cyclicals. We want to have sensitivity to the business cycle. We're overweight in consumer discretionary, in industrials, in materials, and also even in financials, because the perception about financials will change radically if the economy starts doing better.
Rick Bensignor, I want to give you the last word.
Yeah,
Go ahead.
We're actually underweight discretionary.
Underweight discretionary.
Right. We like staples.
You like staples?
We actually like energy kind of longer term. We're willing to sit with maybe another 400 to 700 basis points of underperformance because we like it long term. But financials, we're not ready to come back in.
No. Why is that? Because of interest rates?
Well, Interest rates, partly. Part of it also is if you look at the actual performance of financials versus the S&P, they continue to make new lows as we go. There's been nothing for all the bottom fishing that's gone on by people on the street. They've yet to actually make any signs of a bottom. So I want to see something that at least says maybe we have a bottom in place before we start.
Got to press you on just the one note. Natural gas, you came out today with that note. You're bullish. You like natural gas.
We like natural gas, especially versus crude oil. For the last month or so, natural gas has been outperforming. Thinks it's just the beginning of a bigger move than natural gas outperforms.
All right, I hear a pair trade coming
Absolutely.
on. All right, I want to thank you very much. Rick Bensignor joining us from Dahlman Rose, Chuck Lieberman from Advisors Capital Management. Thank you very much.